Equity markets don't always crash and they don't always soar. Sometimes they simply go nowhere. That's what we call a time correction. We're all familiar with a price correction, when stock prices fall 10 to 30% in a short span. But a time correction is different. Instead of falling sharply, the market just stays flat, moving in a narrow range for months or even years. For investors, this feels frustrating because your money is stuck, giving you no meaningful return while safer options like bank deposits might have done better. Hello everyone. Welcome back to the channel. In this video, we will understand what's happening when markets are going nowhere. History is full of time corrections. Look at Nifty 50. Between January 2008 and December 2013, it took nearly 6 years just to regain its previous high. Now, over the past year, we've been in another phase of time correction. As of September 2025, Nifty slipped slightly from 25,810 to 24,611. That's negative returns for a full year. No wonder investors are restless. But remember, this is still better than a sharp price crash. The main reason? Earnings growth has slowed in the last year, and foreign investors have been selling due to high valuations. At the same time, local investors have kept markets steady. So while the ride feels flat, this correction is actually healthy after a period of stretched valuations. How does time correction help bring balance back to the market? The stock market is a financial marketplace wherein investors buy and sell shares of publicly listed companies. Each company makes profits year after year. Now, if stock prices shoot up too fast, they may become expensive compared to how much money those companies are actually earning. In a time correction, prices don't really fall much, but they also don't rise for a while. During this time, companies keep growing, their profits increase, and slowly the gap between company earnings and stock prices reduces. So even without a crash, the market becomes fairly valued again, because now the price you're paying for a company better matches the profits it is making. That's how time correction helps bring balance back to the market. The fundamentals of India's economy remain strong: rising disposable incomes, new investors, and easier access through mutual funds and apps. If history is any guide, staying invested through time corrections pays off when growth returns. The key is patience, discipline, and proper diversification so that one bad phase doesn't derail your portfolio. Remember Warren Buffett's famous quote, "The stock market is a device for transferring money from the impatient to the patient." So if your portfolio feels stuck, don't panic. Time correction is just another phase in the market cycle. Remember, successful investing is less about timing the market and more about time in the market. Nobody can perfectly guess the market bottom. And when the market starts climbing again, it usually happens so fast that by the time you react, you've already missed the best part of the rally. That's why it's smarter to stay invested instead of trying to time the moves, and the rewards will follow. Thanks for watching, and don't forget to like, share, and subscribe for more insights on smart investing.